It's been a while since we've last spoken about SMCI. The first time we touched on the company was, I think, in January of this year. Since then, the stock has gone up 200% at the time of making this video. But in the last 3 months, the stock is down 25%. Now, overall, right now, it's true that compared to its 5-year mean, the stock is more expensive on all of those valuation metrics, right? Forward PE, EV to EBITDA, price to sales. Price to free cash flow right now, that's in the last 12 months. There are some investments going on, so it's a hit on the business. So right now we can't really look at that metric and make some conclusions. But if you look at price earnings to growth, we're at 0.56. Now it's true that in the past, especially in 2022, early 2023, it was a bit lower. But most companies, when you see that metric, it's under 1, usually that means it's undervalued. Now, undervalued? You just said it's up 200% year to date. Well, yes, it's up for good reasons because the business itself has accelerated, has exploded in the last couple of quarters, especially the last 2 quarters on a year-over-year basis. But in the last 3 months, stock took a breather, down 25%, and so that's why I wanted to touch on this yet again, because when the stock is up, when it was at 1,000, suddenly price targets are going up and up and up. Everybody's hyping this thing up. But now that it's down 25%, suddenly you don't hear a lot about Supermicro Computer. So what exactly has changed? Well, we're going to talk about that in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, hit the notification bell, do all of that. I really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's first start off with a little recap of what happened in Q3. Revenue increased 200% year over year, 5% quarter over quarter. Gross margin on a non-GAAP basis came in at 15.6%, up 10 basis points quarter over quarter, but down 210 basis points year over year. Again, this is not a high margin business, and right now they get hit on margin because they want to take more and more market share. Earnings per share, non-GAAP basis, up $1.06 quarter over quarter, up $5.02 year over year. Cash flow from operations, cash flow used in this quarter, so that's down $925 million quarter over quarter and down $1.71 billion year over year. With regards to the revenue mix, and this is in my opinion a positive because, well, we don't know what will happen in that region. I'm talking about China, Taiwan. China is only 1% of total revenue. 70% comes from the United States, 7% from Europe, 20% from Asia, 3% from other, but only 1% from China. So that's good. And here again, non-GAAP gross margin, you can see that for the last couple of quarters, it has come down. They say here that's due to product customer mix and focus on market share gains. We've seen that with Dell as well and HP. If we look at their outlook projection, so for Q4, they expect revenue to be at $5.1 to $5.5 billion. For the full year, $14.7 billion to $15.1 billion. Now, for revenue, that will increase 142% year over year for Q4, and that's up 37% quarter over quarter. So we're definitely seeing an accelerated growth. Because if we look at the analyst estimates, fiscal year 2024, sales growth 109.5% year over year, EPS growth 101% year over year growth. For fiscal year 2025, sales growth of another 58.4% year over year, EPS slowing down but still growing quite nicely, 41.84% year over year, and then we're slowing down even more in fiscal year 2026, but still sales growth of around 19.3% year over year, and EPS growth closer to 24% year over year. Those are the estimates. Of course, those can change over time. But the company is still seeing some growth ahead, and analysts are still expecting quite some growth ahead as well. So we're not nearing the peak just yet of that super cycle. Why is that? Well, more recently, Supermicro pitches liquid cooling to create more efficient data centers, expects adoption to hit 30%. So Supermicro Computer expects to use direct liquid cooling technology in 30% of its racks next year, marking substantial growth for technology that can help make data centers more efficient. The push to increase spending on AI has significantly increased the demand for electricity, leading analysts to believe that environmental impact and electricity consumption from hyperscalers will become a larger part of the AI story. 100% agree here. During his Computex 2024 keynote speech, Supermicro top boss said that the company expects 15% of global new data center deployments to use its direct liquid cooling technology in the next 12 months, and up to 30% in the following year. He continues by saying that he expects the industry to reach 30% adoption for direct liquid cooling in the next year or two, up from 1% in the last 30 years. Of course, in the last 30 years, okay, thank you for that stat. Creating another big hockey stick growth curve. In comparison to traditional air cooling, direct liquid cooling can provide a more cost-effective and environmentally friendly alternative. He said that Supermicro can build 1,000 racks equipped with liquid cooling in a month and ship them 2 to 4 weeks. He added that the company can make liquid cooling solutions at a lower cost compared to air-cooled counterparts. He says it can reduce ongoing data center power usage by up to 40%. If that's the case, of course, all of the customers are going to come running at Supermicro Computer. Now, if you have a gaming PC, a gaming rig, you probably have either air cooling or liquid cooling. But now, of course, we're talking here about data center, things that heat up quite a lot, use quite a lot of energy as well. So you can see why this is going to look quite appealing if, of course, that 40% number is accurate. But even anything closer to it, right? Even if it's 30%, that's quite a lot of money saved. Now, during the week, Supermicro did go up. I think one day it was up 6-7% or so. I believe that's because of the positive comments we got from Oracle and from Broadcom as well. So that helps a company like Supermicro. Another thing here is the stocks with the largest and least short positions. You can see that number 3 here is Supermicro Computer. Number 1 is Enphase Energy. Supermicro short interest 7.26%. This is from the S&P 500, by the way. Short shares sold over 4 million. So maybe that might have, in this case, a positive effect since it's shorted quite a lot. A move on the upside might turn into a small squeeze. And so right now, yes, it is true, the stock is up 200% year to date. Yes, it is also true that valuation-wise, we are much higher than its 5-year mean. But if we were to believe the analysts, if we were to believe management comments and the industry comments as well, then there is a lot more growth ahead for this company. So, as long as the business continues to grow extremely fast, faster than the stock, this could be seen as an undervalued stock right now. Of course, if suddenly the stock doubles and the business does not perform as well, then of course we're going to enter overvalued territory. So far, that's not the case. And so if we look at the graph right now, we can see that early March, the stock was extremely overbought, but then again, it was overbought for close to 2 months. And still the stock went up and up and up. So just because we're seeing a stock being overbought does not mean that it cannot go higher. If there is momentum with the business, if there is momentum with the stock, it will definitely go higher. But since then, the stock did drop around, well, if you go to the lowest point, it did drop 45%. Of course, right now we're a bit higher. So since that top, we're now down 31%. If we look at RSI, yes, it did go up a little bit. Nowhere near being overbought just yet. The 200-day moving average, which is the blue line right here, sits at 627, the 50-day one at 836, and the 20-day one at 818, meaning we're now on the weekly above the 20 and the 50-day moving average. Of course, would have loved maybe to pick up some shares. I have no position in this company, but if it were a bit closer to the 200-day moving average, would definitely be tempted to open one. But so far we're seeing the stock stabilize here around, well, between, let's say, $750 and $850 or so. And so as we enter the next phase, right, the phase of direct liquid cooling, the next phase of investments in AI, where companies might not see the ROI that they expected, maybe they're going to go and look for solutions that might save them money in the future. They can go back to SMCI, Dell as well, but in this case, we're talking about SMCI. By the way, we've talked about Dell, we've talked about both of those companies. This is not a high margin business. This is a business that, yes, it will go through cycles, but don't expect them to print billions and billions in free cash flow. That's just not going to happen, especially not in the short run, as both of those companies want to get as much market share as possible. But To conclude, yes, I do think that there is right now, since not a lot of people are talking about this, I think it might be an opportunity, especially if you're a holder of FMCI or if you are looking to add SMCI to your portfolio. I think there might be some value there. Of course, might be wrong. Do share your thoughts and comments down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. I'll see you all in the next one. Bye bye.